We now come to the final part of this reading, which is credit and liquidity risk. Credit risk involves the probability of default and degree of recovery if default occurs. This is something we'll see in a lot more detail in the reading on credit analysis. Liquidity risk refers to the transaction costs associated with selling a bond. In other words, if you own a bond and it is very expensive for you to sell the bond, you believe that the market price is 100, but it is hard to find buyers, and to actually offload this bond, you need to sell it at a much lower price. This would mean that the liquidity is low or the liquidity risk is high. These are just definitions. Now the key point for this section: for a traditional or option-free fixed rate bond, the same duration and convexity statistics apply if a change occurs in the benchmark yield or a change occurs in the spread. Here we connect back with something that we saw in the previous reading. The total YTM of a corporate bond has two components. There is the benchmark yield. Let's say that we are talking about a 5-year bond with YTM equal to 6%. And of that 6%, 5% is coming from our benchmark. In other words, a comparable government bond has a YTM of 5%, and then 1% is the spread. This 1% is because of the credit risk and liquidity risk. Here we are assuming option free and we are ignoring any impact of taxes. So what will happen if there is a change in the spread? The impact can be calculated using the duration and convexity statistics that we've talked about. In other words, we've said earlier that if interest rates go up by, let's say, 50 basis points, then convexity and duration can be used to calculate the impact on the bond price. Similarly, if the spread here changes from 1% to 1.5% or 150 basis points, then the impact on the price can be calculated using the same duration and convexity statistics that we've been talking about all along. As I have alluded to, the change in this spread can result from a change in credit risk or a change in liquidity risk. If the credit risk increases, then the spread will increase. Similarly, if the liquidity risk increases, then the spread will increase. And as a final remark, in practice, there often is interaction between changes in benchmark yields and spread over the benchmark. Let us now go over an example which illustrates what we are talking about. And I want you to do this first. Here is what you need to do. Recognize that the bond price changes from 92.25 to 91.25, and this is because of a downgrade which has to do with credit risk. The percentage change is minus 0.01084. That's expressed as a decimal. In percentage terms, it would be 1.084%. Then remember this formula. The percentage change in the price of a bond is equal to minus modified duration into the change in yield. The change in yield is what we need to figure out over here. The change in yield is because of the higher credit risk. Plug in the numbers and you get a change in yield equal to this amount. This is in decimal. In percentage terms, we'll have 0.1497%, or in basis points, we have approximately 15 basis points. The correct answer, therefore, is A. And the interpretation is straightforward. When the bond is downgraded, the price comes down, which means the yield goes up. That yield goes up by 15 basis points. And if we think about what's going on, the yield to maturity is a function of the benchmark rate, so the interest rates in the market, let's say the government rate, plus the spread. Because of the downgrade, the only thing that is changing is the spread. So the market interest rates or the government bond rates are staying the same. This increase in spread is causing the YTM to go up, and that increase in spread is due to the downgrade. And notice that we used a standard duration formula to compute this increase in spread.
In this reading, we've been using mathematical formulas to estimate duration and convexity. This approach, where we use mathematical formulas, is called analytical duration. And here the assumption is that the benchmark yield and credit spreads are uncorrelated. Empirical duration, on the other hand, does not depend on this assumption. So empirical duration uses statistical methods and historical bond prices to derive the price-yield relationship. It does not assume that the benchmark yields and credit spreads are uncorrelated. Now, looking at government bonds, these will have similar analytical and empirical duration because here there is no credit spread. So since there is no credit risk, the value that we will get using analytical methods and empirical methods will be the same. However, with high yield bonds, the empirical duration will be lower than the analytical duration. This is because credit spreads and benchmark yields are negatively correlated. And let me quickly explain why. Let's say that the economy is not doing very well. In this situation, money will move out of high yield bonds into government bonds. So the government yield will come down. We can say that the benchmark yield comes down. And also during this time, because the economy is not doing well, the probability of defaults goes up. Therefore, the credit spread associated with these high yield bonds goes up. So notice this negative correlation between the credit spread and the benchmark yields. And because of this negative correlation, the empirical duration is lower than the analytical duration. An important point here is that analysts must consider the correlation between benchmark yields and credit spreads when deciding whether to use empirical or analytical duration estimates.
We are done with the reading. Let us now summarize the main points. You need to understand the sources of return. When you invest in a bond, what money do you get? You get the coupon payments plus principal back. You reinvest the coupon payments and there is an income which comes because of that reinvestment. And then there might be a capital gain or capital loss associated with the price of the bond. This happens if your investment horizon is less than the overall maturity of the bond. And here I want to emphasize the fact that if you buy a bond at a discount, then there is a certain trajectory called the constant yield trajectory, and the capital gain or loss depends on the price at which you sell relative to the constant yield trajectory. Next, you need to understand Macaulay and modified duration. The Macaulay duration is simply a weighted average of the cash flows. Modified duration is linked to Macaulay duration. Modified duration is Macaulay duration divided by 1 plus R, where R is the interest rate for one period. The interpretation for Macaulay, as I just said, is based on a weighted average of the cash flows. The interpretation of modified duration is that a 1% change in yield, let's say yield goes from 9% to 10%, so the yield increases by 1%. If modified duration is 5, then there will be a 5% change in the value of the bond. Approximate modified duration can also be thought of as the slope of this particular tangent at a given point. So if you have the price yield relationship, then the approximate modified duration is simply this curve over here. You should also know the formula for approximate modified duration. That formula is PV minus, which is the price if interest rates go down, minus PV plus over 2 times the change in yield expressed as a percentage. So that change in yield would be this distance. And then multiplied by PV naught, which is the original price. Macaulay duration and modified duration, these statistics work for straight bonds or conventional bonds where the timing and amount of cash flow is known. Macaulay and modified duration, however, do not work for bonds where there are embedded options. For bonds with embedded options and mortgage-backed securities, the appropriate measure is effective duration. Effective duration is a curve duration, and here instead of using the change in YTM of the bond, we look at the change in the government bond interest rates or the change in the benchmark interest rates. You need to understand the relationship between interest rate risk and these variables. When maturity is higher, then interest rate risk is higher. When coupon rates are lower, then interest rate risk is higher. With embedded options, here is what happens. If you consider a callable bond, then the price yield relationship is something like this. An embedded option, if it's a call option, reduces the interest rate risk at low yields. What about the relationship between yield and interest rate risk? Notice that this slope is higher at low yields, which means that interest rate risk is higher at low yields. And with both these pictures, we have price on the y-axis and yield to maturity on the x-axis. Money duration and price value of a basis point. Money duration refers to the monetary impact of a change in interest rate. Price value of a basis point is the change in dollar value of a bond or a bond portfolio if the interest rate changes by 1 basis point. Approximate convexity and effective convexity. Convexity refers to the curvature of a bond, and we need to make a convexity adjustment when we calculate the approximate price of a bond in response to a change in interest rate. Effective convexity applies when we are dealing with bonds which have embedded options. Yield volatility is important. The higher the yield volatility, the higher the interest rate risk. Holding period return and investment horizon. The quick point here is that if the investment horizon is long relative to the Macaulay duration, then an investor is concerned about interest rates going down, because then coupon payments would be reinvested at lower rates and the impact of reinvestment income dominates the impact of a change in price. If the investment horizon is short relative to Macaulay duration, then an investor is concerned about a rise in interest rates.
Credit risk involves the probability of default and degree of recovery if default occurs, and liquidity risk refers to the transaction costs associated with selling a bond. If the transaction costs are high, that means that the liquidity risk is high. And the final thing we talked about is empirical duration, which is different from analytical duration. All the other duration measures we talked about are analytical in the sense that they are calculated using mathematical formulas, whereas empirical duration is calculated using statistical methods. So that is it for this reading. As I keep emphasizing, you need to practice a lot, and especially in this reading where there are many calculations. So do as many questions as you can, do the questions in the curriculum, the practice problems, and also work through the IFT question bank. That is it. Best of luck.